In a previous presentation, we did discuss setting up a 0 days to expiration spread using the search settings on Power Options. This was simply a credit spread that we were using to identify positions. You can view that video with the link below, or just go to the Power Options YouTube and search for setting up a 0-day spread. Now, last week, Anthony had asked, does it make sense to do an iron condor on SPY, 0 days to expiration, and exit at a 50% profit? What we're talking about is opening an iron condor, a bull put credit spread, and bear call credit spread with the same expiration date on SPY in the morning for that day's expiration. Monday, Tuesday, Wednesday, Thursday, and Friday expirations now, so you can do it daily. But you're going to close it before the market closes, hopefully reaching a 50% profit. Now, our initial thoughts, this is not our approach. It requires too much time to watch, even with stops set in place at your broker or on the Power Options portfolio tools. It's not something we could backtest during the webinar because the historical data on Power Options is end of day. So we wouldn't see the intraday history. It had to be done in real time. So, of course, we're up to the task. On Monday morning, November 21st at 9:25 a.m., we created a search for the Iron Condor 0 days to expiration. The first step, since this is a very specific search, is to click Clear Filters and empty everything out of the parameter field from a previous default search. Then we input the basics. We selected our expiration time frame to be all expirations and set the days to expiration to be blank to 1. Don't use 0 to 1, just use blank to 1. Look for a basic return of 1%, and we did want the probability above the short put to be greater than 79%, and the probability below the short call in the bear call spread to be at least 79%. To keep things simple, I also wanted the same margin on both spreads. I didn't want to mess around with a 2-point bull put credit and a 5-point bear call credit. We want them to be the same strike differences. Now, this percent out of the money range between 40 and 60 does not mean looking 40 to 60% out of the money. What this does is help us set a range where the strikes of the call and the put are close to equidistant from the current stock price. A range of 50% out of the money means it's both sold options would be the same distance apart from the current underlying price. So we don't want to skew bullish, we don't want to skew bearish, we want it almost right in the middle, and that's what this percent out of the money range is doing. And of course, we're going to screen just against SPY. Now, initially, I had a foul up. I accidentally did blank to 2 days when running the search, assuming just a Monday, Wednesday, and Friday expiration. This slipped my mind of the Monday, Tuesday, just about daily expirations on SPY and SPX now. Speaking of which, I accidentally used SPX instead of SPY. We came across a 20-point spread on Monday morning for Tuesday, the 22nd expiration, 2 days away, for SPX. Now, we'll come back to that. We did start tracking that trade, but we realized that we weren't doing exactly what Anthony had asked. But we got it right on Tuesday. Those criteria that we used, the right criteria, on 11/22, November 22nd, Tuesday at 9:55 a.m., SPY was trading at 395.85. That search showed us that we could sell to open a 390 put for that day's expiration for 18 cents. And buy a 388 put for 7 cents. The 22 November 390 put had an 88.5% probability above and a delta of minus 0.113. At the same time, we'd sell the 22 November 399 call, SPY at 395.85. We'd take in 17 cents. This had a 76.2% probability below and a delta of 0.246. To complete the bear spread, we bought the November 401, keeping the same margin of 2 points for 4 cents. We took in 11 cents of net credit on the bull put, 13 cents of net credit on the bear call, for a total of 24 cents net credit on the Iron Condor, with a true risk of 176. So this was a potential 13.6% return. However, the plan is to close this position if the debit to close these 4 legs is only 12 cents, so we'd get a 6.8% return in 1 day against the true risk. On Tuesday, however, SPY, SPX had a solid movement. We're up 531 to where it closed at 399.90, above the short call strike price. However, in the middle of the day, around between 11, 12, and 1 o'clock, there was a lull. So could we have closed this position for at least 50% profit as SPY was meandering about for that hour, hour and a half? Unfortunately, no. In fact, it hit near the 50% loss, closing the position for a debit of 36 cents, 12 cents higher than the 24-cent net credit we collected before it reached a reasonable profit. Here's a breakdown of the morning. We use the portfolio tools and power options to evaluate the liquidation value in real time. Remember, we opened the Iron Condor for a 24-cent net credit when SPY was at 395.85. At 10 a.m. Eastern, just about 5-6 minutes into the trade, it would have cost us 24 cents to close the position. No gain or loss, no percentage gain or loss. SPY is 396.45. Hasn't really moved yet. At 10:15, SPY at 397.05 would have cost us 28 cents to close the spread. We would have had a loss of 4 cents on the position, or a loss of 16.7% against the initial net credit of 24 cents. At 10:30, we're back to a wash, 24 cents to close all 4 legs as a debit. No gain or loss in the position. SPY is at 396.86. 11 o'clock. SPY goes to 397.30. Would have cost us 22 cents to close all 4 legs. Monetary profit of 2 cents because the 24-cent net credit was taken in. We've got a gain of 8.3% against that net credit. 2 cents against the 24. Half an hour later, a little bit cheaper to close, 19 cents. We would have seen a 5-cent profit on SPY Iron Condor. With SPY trading at 397.18, it fell back a little bit. We're at a 12.8% gain. But then at noon, SPY starts to move back up again. It would now cost us 25 cents to close the position, a loss of 1 cent or 4.2%, with SPY at 397.59. And as we moved into the afternoon, SPY continued to move up in price. Now, it didn't reach above the short call into the afternoon yet, but it did close there. And we weren't at 50% of the maximum loss, that 176 we could have taken on the position. But going forward at 12:30 p.m. Eastern Time, buyback cost of 26 cents, loss of 2 cents total, or 8.3%. SPY is at 397.41. At 1 p.m. Eastern, SPY is at 397.71. The bull put credit spread side we could have closed for 90% profit of what we originally took in, at 11 or 13 cents, I believe. However, the bear call is now losing. At 1 p.m., it would have cost us 30 cents to close the position. We're at a loss of 6 cents total, or minus 15.4% against the net credit. And as SPY continues to move up, it just keeps getting worse. At 1:30, a cost of 31-cent debit to close all 4 legs, loss of 7 cents from the 24-cent net credit we took in, or 29.2% down against the net credit. SPY is at 398.21. At 2 o'clock, 33-cent debit to close, a loss of 9 cents, or a loss of 37.5% against the 24-cent net credit. SPY is at 398.48. Hesitates a little bit between 2 and 2:30. At 2:30, almost exactly, 32-cent buyback cost, loss of 8 cents, or 33.3% against the net credit. SPY is at 398.40. And at 3 p.m., it would have cost us 63 cents to close the position, mostly the bear call side. Stock's at 399.36. It's above our short call strike price, the 399 call. We would have had a loss of 39 cents total, or roughly 162% compared to the net credit of 24 cents. The 50% loss, the buyback, where it would have cost us 36 cents to close the position for a loss of 12 cents total, taking into account the 24-cent net credit, was triggered on power options at 2:15 p.m. Eastern Time, and also at around 2:40 p.m. Eastern Time as well. The spread started to get away from us. We simulated closing the trade around 3:15 p.m. Eastern Time. The midpoint for a 390 put and the 388 put were 1 cent each, essentially a wash. Yeah, we might have had to pay 2 cents for the 390, got 1 cent for the 388. We're just going to call it a wash at midpoint. We would have had to buy to close the 399 call for 63 cents at 3:15, and we only got about 3 cents for selling to close the November 22nd 401 call in the bear call spread. A total liquidation cost would have been 60 cents debit. We kept the initial 24-cent net credit, so we have a loss on our first 0 days to expiration Iron Condor of 36 cents. Now, you know me. We didn't just close the trade. We evaluated the 8 ways to manage a credit spread to manage the failing bear call side. We did decide to just roll the position. Just moving up the sold call from the 399 strike to the 400 did not work because we were within 45 minutes to expiration. The pendulum adjustment, where we turn the bear call credit into a bull call debit by swinging that 401 call down to the 397 and leaving the 399 sold call in place, did not work either. We're too close to expiration. We could have closed the losing side, the bear call, realized the 36-cent loss, and opened a bull put credit spread attempting to find a 40 or 44-cent net credit to convert the loser to a winner. Couldn't have been done with the same expiration. We would have had to go out in time. Of course, what we did choose is closing the bear call spread that was losing, our 399 and 401 spread, taking the 36-cent loss, and then rolling essentially or opening a further out in time bear call with a higher probability. But in order to get the credit, we had to increase the strike width, which increases the total risk. So we closed the trade. And we opened a 1 week out, actually 10 days to December 2nd, bear call spread by selling the 412 call for December 2nd on SPY at 74 cents and buying to open a 417 strike call, 5 points apart now instead of 2, for 30 cents. This would give us a net credit of 44 cents for that 10-day bear call spread, but we have to account for the realized loss of 36 cents on our failed 0 days to expiration Iron Condor. So the new max credit for 10 days out in time is 8 cents, trying to convert a loser to a winner, but having to go out further in time and increase the strike differences. And our new max risk now is $4.92, almost a little bit less than 3 times the original $1.76 at risk for the Iron Condor. Here's the new position out to December 2nd. We're reflecting a cost basis on the 417 call of 66 cents to account for the 36-cent loss we took on the initial Iron Condor, and taking in 74 cents for our 412 call out to December 2nd. Now maximum profit of only $8 or 1.6% for a 10-day trade. We have to wait till 2nd of December, 10 days away from November 22nd. Again, we had to increase the risk, and the stock was moving in the direction of the bear call spread. So I mentioned it might have been better to close and do the opposite. We're attempting to potentially avoid a loss, but now we have to go further out in time, increase the risk, and do commissions come into play based on the small net credits we're looking at and the contract size you might have chosen for this strategy. Moving forward to Wednesday, November 23rd, second Iron Condor, 0 days to expiration. We've got the criteria correct, but we're going to make a subtle change. We're going to open a condor Wednesday morning for November 23rd expiration, same day. We're going to look to close it at a 50% profit, but let's move that probability up. Instead of the 76% probability we took on the bear call spread, which essentially got us into trouble because there was a strong movement on SPY, we're going to look for both to be above 80 or as close to 85%. 9:39 a.m. Eastern Time, just after the market opens on Wednesday, November 23rd, SPY is trading at $400.57. The bull put we identified on the search, sell to open the November 395 put, about 5 points below the current price, for 13 cents, keeping the 2-point distance. Buy the same expiration November 393 put for 6 cents on the bull put side. Our sold 395 put has an 89.9% probability above at expiration a few hours away, and we have a delta of minus 0.121 for the 395 put that we sold. Completing the Iron Condors, sell to open the 23rd November, 405 call for 11 cents. This had an 84.3% probability below and a delta of 0.173. Keeping the 2-point distance, same margin on both sides, buy to open the 23rd of November 407 call for 2 cents. 7-cent net credit on the bull put side, 9-cent net credit on the bear call side for a total of 16 cents of net credit, with a true maximum risk of only 184. So we're looking at an 8.7 potential percent return. But intraday, we're going to look to close the position for an 8-cent debit to keep 8 cents of the maximum 16-cent net credit, which would come out to be half, or about a 4.4% return. Now, we saw Tuesday, but now looking at Wednesday, we're a little bit up at the open, continuing the trend from Tuesday's close. But then we have a nice little pullback and a settling, a breather in the middle from about 11 o'clock to almost about 2 p.m. Eastern Time. This lull could help the position with the time decay we're hoping for. But did it affect the Iron Condor 0 days to expiration as we were hoping? Remember, we took in 16 cents of net credit at about 9:39 in the morning. Position was open when SPY was at $400.57. We did look at better probabilities, of course, because we got in trouble the day before. At 10 a.m., debit to close all 4 legs was 19 cents. This would have been a 3-cent loss on the spread, or minus 18.8% against the 16-cent net credit. SPY was at 401.38. At 10:15, the debit to close was 15 cents. So we would have kept a 1-cent profit, or 6.2%, against the 16-cent net credit. SPY was trading almost at 402, at 401.94. 15 minutes later, about 10:30 a.m. Eastern Time, debit to close is 14 cents, 2-cent profit, or 12.5% against the net credit. SPY is at 402.01. At 11 a.m., another 15 cents, debit to close the position, profit of 1 cent, 6.2%. SPY is at 401.88. We're staying right in this 401 to 402 range, right around 402. At 11:30, getting a little bit better. At only a cost of 12 cents to close the position. We would have kept a 4-cent profit, or 25% of the 16-cent net credit we expected, and SPY is right around 402 at 401.98. At 12 noon, SPY started to pull back. It pulls back to $400.17. Now we have a switch. We still have a 25% profit. The debit to close was still 12 cents, so we'd make a 4-cent profit. But now the bull put is losing, and the bear call side is at near a 50% profit on the position. But as a total, we're only at 25% profit. And as we go into the afternoon, we saw the chart, SPY started to stagnate, which is the best movement we want to see for an Iron Condor. We held around that $400 price range, and that stagnation was just what we needed to be able to close the position for the 50% profit. At 12:30, p.m., the debit to close was 10 cents. We would have kept 6 cents of profit against 16, or 37.5% return against the net credit. SPY is trading at 452. We pull back at 1 p.m. Eastern Time, almost exactly at $400 for SPY. 9 cents debit to close all 4 legs. Took in the 16 cents, we would have had a 7-cent profit of the 16 we expected. We're at 43.8%, knocking on that 50% maximum profit. And at 1:30 p.m., we see a buyback cost, and the alert was triggered. 8 cents debit to close the position. We'd have a profit of 8 cents, or 50% of what we expected on the maximum net credit, and SPY was trading at 418. So this was essentially closed at 1:35 p.m. Eastern Time for the 50% profit. Remember, we sold to open the 395 put for 13 cents, bought to open the 393 put for 6 cents. We were able to buy to close the 395 put for $8, making a $5 profit. And we were able to sell to close, the 393 put for 3 cents. So we had a loss there of about $3. And on the other side, of course, sold the 405 call for 11 cents. We were able to buy it back for 8. And the 407 call, the higher, we bought it 2. It actually went up to 5 with midpoint prices that we looked like we were able to get. This was a paper trade, of course. So we profited $3 on the long call as well. So the liquidation, 3, 3, and 5, that puts us at 11, minus a $3 loss on the 393 put. We have the $8 cost to close the position, an $8 total profit, or 50% of what we initially expected to make. Now, Thursday, of course, Thanksgiving. We get a break in trading. We got to enjoy some food. We didn't have to watch the 0 days to expiration position. But on Friday, we continued on. Friday, November 25th, we have a shortened trading day. The market closes at 1 p.m. due to the holiday, which means we're still going to be able to find an Iron Condor position 0 days to expiration, but that net credit is going to be much smaller. We ran our search, and at about 9:38 a.m. Eastern Time, SPY is trading at 401.84 on Friday, November 25th. We get an Iron Condor that matches our criteria. We loosened up the probability a little bit, but still wanted it to be above 75%. Our bull put side. Sell to open the 398 put for 7 cents. It's only about 3.5, 4 points below the current price of SPY. And we're going to buy the 396, keeping that 2-point strike difference, for 4 cents. A 398 had a 77.6% probability above, but a delta of minus 0.19. Below 0.2 where we wanted it to be, probability wasn't as high as we'd want. At the same time, our bear call, we're going to sell to open the 25th November 405 call, about 316 out of the money, and we're going to get 8 cents for it. And buy the 25th of November 207 call. I'm sorry, 407 call, my apologies, for 3 cents. So we get a 3-cent net credit and a 5-cent net credit. Our 405 call had an 81.8% probability below and a delta of 0.221. Total net credit from both sides to complete the Iron Condor is 8 cents with a true risk of 192. So we're looking at a 4.2% return, really, for only about 3 hours, since the market closes at 1 and we're opening this close to 10 a.m. Eastern Time. Well, jumped into the position, get an 8-cent net credit. SPY did sort of stagnate during the day. It stayed right between this high 401 to this mid 402 range during the trading day. Again, that's what we want to see with an Iron Condor. We did realize the 50% profit at about 11:02 a.m. Eastern Time. Let's take a look. At 9:45, liquidation cost was 7 cents. We would have kept 1 cent of profit 8 minutes into the trade or so, 12.5% of the total expected net credit of 8 cents. SPY is at 401.87. At 10 a.m. Eastern Time, 7-cent debit to close all 4 legs, 1 cent profit again, 12.5%. SPY is at 402.46. Stays around that price for the next half hour. At 10:30, the debit to close the position was 5 cents. All 4 legs cost a debit of 5 cents. We took in the 8-cent net credit, so we'd have a gain of 3 cents total, or 37.5% of the max we expected to make. SPY at 402.44. Then at 11 a.m. Eastern Time, we see a trigger in the power options portfolio for the alert we set for 50% profit. Liquidation cost is 3 cents. We'd make a profit of 5 cents of the 8 cents total we expected, so we're at a 62.5% profit. SPY staying right around 402, 402.50. It's at 402.59. So we simulated closing the position around 11:02 a.m. Eastern Time. Cost to close was 3 cents, or $3 per one contract, so we kept the 5-cent profit on the 8 cents expected, made 62.5% for the 0 days to expiration. Just wanted to show this real quick. Here's our portfolio view from Friday, November 23rd at 11:01:43 a.m. Eastern Time in the real-time quotes. Here we see the liquidation value of $3, liquidation profit of $5 total, or 62.5% of the 8-cent maximum profit we expected to make on the position. We took it off the table for the profitable 0 days to expiration. This other spread that's here is our managed spread that's still 7 days to expiration. Remember, out to 02 December, selling the 412 call, buying the 417 to counter the 36-cent loss we took on our first 0 days to expiration Iron Condor. I just wanted to show this too. As you can see, it was 7 days to go to expiration. SPY at 402.56 with our 412 sold call and our 417 long. We are still at a wash to liquidate. It would cost us 44 cents to liquidate, which was the initial net credit taken in. So we do not have a profit on this position. We have to wait closer to 7 days away as we get closer to December 2nd expiration. Now that spread was closed at about 11 a.m. Eastern Time, 11:02 a.m. Eastern Time. We have roughly 2 hours left to the early close at 1 p.m. Eastern. Should we open a new Iron Condor position to try to take another 4, 5, or 6 cents? Well, we use the spread chain to take a quick look. This allows us to view credit spreads together, debit spreads, or the parity trades of a bull put versus a bull call debit, and so forth. We put in a minimum probability range of 65%, minimum return, of course, and kept our spread width at 2. We did not see any real viable opportunities. Looking at the bear call, for example, with the 406 sold call and the 408 call with at least a 75% probability, is only a 1 cent credit. Looking for around the same 75% probability minimum on the bull put side. Selling the 400, SPY is only at 402.85 at this point, and buying the 398, again, was only a 1 cent net credit. That's not worth it. We'd only get 2 cents total for the 4-leg transaction. Try to close it at 1 cent for a 50-cent profit. Not what we wanted to see. Would we take the lower 67% probability and 69% probability? That would only give us 6 cents of net credit total. 4 cents on the bull put side, 2 cents on the bear call side. Just didn't seem viable to try to fight for those pennies entering a new position after the first Iron Condor was closed. So we just let it go. Maybe we should have just held it open to receive the full net credit on our initial trade. All right, so 1 week does not the market make, but let's review the results of our 0 days to expiration Iron Condor on SPY for Anthony. Now, we ignore Monday's trade. We accidentally searched SPX, not SPY. It was a 2-day trade, not a 0 days to expiration. It did work out, but it got really, really close. At one point, I believe on Tuesday, the 22nd of November, it was around 4,003. I reached up to that point and probably would have been forced to close or roll that 4,005 strike call that we would have used. But anyway, this was a 510 net credit on a 20-point spread. Would have been about a 34.2% return. And in 2 days of trading, it did end up expiring worthless, but there was a moment we probably would have had to roll the sold call on Monday as we saw it started to shift up and go into those 400 levels, and it peaked out at about 4,003, 4,360. So we probably would have been at a trigger to roll the 4,005 call. Well, we're going to ignore that because it wasn't exactly what we wanted. So starting on November 22nd, Tuesday's trade, got a 24-cent net credit. SPY moved up 531, or roughly about 1.4%. We had to close the trade at a 36-cent debit, which was a 50% loss against the total net credit we received of 24 cents. We lost 12 cents out of the 24 we were hoping to make, or the 12 we were hoping to make if we could close at a 50% profit. We decided to roll this position out 10 days, accounting for the 36-cent debit to close the position. The new net credit was only 8 cents. We still have 7 days to go, and as we saw, right now liquidating is just a break even. It's a wash, so we'd still be down to 12 cents on this structure, even with the management in place. We've got to wait till closer to December 2nd expiration. Wednesdays and Fridays, 0 days to expiration Iron Condor. On November 23rd, we opened this position for a 16-cent net credit. We were able to close it for the 50% profit around 1:35 p.m. Eastern Time. Thursday, November 24th, markets closed. Friday, November 25th, shorter credits because it's a shortened trading day. The market closes at 1. We only received an 8-cent net credit. We were able to close at 11:02 a.m. for a 3-cent debit, so we did make a profit of 5 cents on the position of the 8 expected, 62.5%. We got out with a 50% profit. Total profit on the winning trades, 13 cents. Total loss if we just liquidated the losing trade on Tuesday was 12 cents. So looking at maybe only a 1 cent profit total with this approach for the week of November 22nd through November 25th. Shortened trading week, add a mistake on Monday using the SPX trade. Again, 1 week does not the market make, and 1 shortened holiday week does not the market make. But would we consider this a success? 2 out of 3 trades were successful, 66.7%. Those of you who trade credit spreads and Iron Condor know you need a success rate of closer to 80, 82, or 85% to be successful long term. This doesn't look like it's cutting it. The total profit, if we just liquidated the 3, didn't mess around with rolling for 10 to 7 days out in time, again, just would have been a 1 cent profit on 3 trades. $12 loss on the Tuesday Iron Condor, 13-cent gain on the successful Wednesday and Friday Iron Condors. All right, we did roll to attempt to turn the loss to a profit, had to go 10 days out in time. More importantly, we had to increase the strike difference in order to get that 44-cent net credit to counter the debit of 36 cents. Now, the max profit on the roll is only going to be 8 cents, or 1.6% return against the true risk now of 492. Now, if we take into account the 2 successful trades with a 13-cent gain, and if this management gets to the full profit of 8 cents, but hey, would we close that at 50% profit? I don't know. I don't think so. I probably want the full 8 cents. So we could see a max of 21 cents of profit in 10 days, including the management, or a 4.4% return for roughly 10 days of trading against the 5-point risk, or really 479 maximum risk on the new bear call spread that's out to December 2nd. So it averages to be about 2 cents per day in that case, or about 0.4% per day. That doesn't sound too bad at 0.4%, but I don't know if this is hitting the targets you want. I'm not seeing the success rate I want for any type of condor or credit spread approach. I need that to be 82, 85% success rate, not 67. That's a recipe for disaster. But again, 1 shortened holiday trading week does not the market make. The full disclaimer, this test was done on a shortened week. Although we did use the Power Options portfolio tools to set alerts for a 50% profit or 50% loss, we manually track this every 30 minutes so that we could see the data and you could see the data. We could share it with you. We could share it with Anthony, how each trade did every 20 minutes, every 30 minutes or so, sometimes every 15 minutes as we got closer to the expiration. Even if I had the stops in place, I'd want to be watching this position constantly, and that's not the effort that I want to put into a strategy in my portfolio, especially for the return and the success rate that was shown. Even though, again, it was on a shortened week, it was really only 3 examples. We're not going to get into position size. The risk to take with the difference in strike price is the minimum net credit you should look for. That's going to have to be determined by the individual investor. We wanted to illustrate this for Anthony, illustrate how we don't think that this is going to be something that we are going to use in our portfolio or expand on anymore. It takes too much time, it takes too much effort, and it doesn't seem like the reward is worth it for that effort. However, we did see some success. 2 out of 3 trades were successful without management. It's possible, as always, that that management we used could turn the losing trade into a winning position, but we had to extend the time from 0 days to expiration to 10 days out in time in order to find a successful management. I hope you enjoyed this insight and this presentation. Again, this is not something I'm planning to expand upon or Ernie's planning on expanding on anytime soon. Anthony asked the question. We had to do it manually to show the answer, and I think you can see why we're not planning on expanding any kind of education or approach with the 0 days to expiration credit spread or Iron Condor on SPY, SPX, NDX, or other broad-based ETFs and indexes.